So, welcome to my channel or page where I translate technical accounting lessons to a storytelling version, sort of. And today, we are going to continue the past episode. But first, here's a short recap. So, I told you about this non interest bearing note. But despite its name as non interest bearing, interest is actually already embedded in these payments. Now, we assumed an implicit rate of 12% in the past episode, but we took out the implicit interest by discounting these payments, and we end up having a present value of 800,269. So this is what we are going to record in accounting initially. Okay? Now, we have also completed this timeline to get the subsequent measurements of the notes payable. So that's the short recap for the past episode. And in addition, this timeline that we have created has an alternative. So you can actually use a table instead of this one. And to know how to do it, and if you want a comparison between this timeline and the amortization table and how to use them, just see the description below and click on the link to a playlist and find the video lecture there entitled, if I'm not mistaken, Timeline Analysis versus Amortization Table. Okay? Now, let's continue the video. This video is made in order to, first, present how to record the notes payable initially and subsequently, and second, how to present them in the financial statements. Okay? Now, let's begin with how do we record initially. So, this present value here will be debited to cash if supposedly you received cash. But if you received something else, then the debit will also be something else. Like if you received a property, so debit property, and of course, credit notes payable still. So let's assume again that you received cash. That is why you executed this instrument. So the entry will be debit cash 800,269 and credit notes payable for the same amount. So that's the initial entry. Okay? Now, after 1 year, you will need to debit already interest expense, which is again the difference of this after interest amount of 896,301 and this initial balance. And we will get 96,032 as the interest expense. Okay? And since the notes payable decreased also, so take a look at this. So it has decreased from 800,000 plus to 500,000. So that difference will be debited to notes payable. So the difference of the two is 203,968. Okay? And lastly, we have a credit cash for the payment, which is 300,000. That's the first payment. And that's the entry for year one. Easy, right? And it gets easier. Why? Because the entries for the next 2 years, the end of year 2 and the end of year 3, will be very similar to this. So debit interest expense, and then debit another one, which is notes payable account, and then credit cash for the scheduled payments. Again, the interest expense is after interest amounts minus the before interest amounts. So for the end of year 2, that's 667,857 minus 596,301, and that is equals 71,556. Okay? And for the year 3, that's 300,000 minus this 267,857, and that is equals 32,143. Okay? Now, for the notes payable, we just have to compare the balances. Like in the end of year 2, we have 267,857 versus this 596,301. So get their difference, which is 328,444. And that should be debited in the notes payable at the end of year 2. Okay? In the end of year 3, of course, we have 0 versus 267,857. So 267,857 after 1 year is already 0. So that means we need to debit here 267,857. Okay? So those are the debits. And the credits are simply the scheduled payments of 400,000 at the end of year 2 and at the end of year 3, 300,000. Okay? So that's it for recording. Now, what's next? What's next is related to the presentation of these balances here. Whether the whole balance will be reflected 100% to current liabilities or 100% to non-current liabilities, or are we going to split the balance to current portions and non-current portions? Like, for example, in this year one, at the end of year one, we have 596,301. Are we going to report it or present it in the financial statements as non-current, or are we going to present it as wholly current liabilities? Or are we going to split this? Okay? So, to know that, we need to advance to the next 12 months, which is the end of year 2. And as you can see here, there is still a payable balance left. Although, it was decreased from 596,301 to 267,857 only. So, what does that mean? That basically means that this balance at the end of year 1 is composed of current and non-current portion. So, the non-current portion is the balance after 12 months, and that's 267,857, and the remainder, or the decrease from here to here, which is 328,444, that will be the current portion. Okay? Now, moving forward, we have 267,857 at the end of year 2. Let's know if ever this is 100% current, 100% non-current, or are we going to split this balance also? To do that, let's move forward 12 months later. And as you can see here, the notes payable balance is 0. So that only means one thing. The whole 267,857 balance at the end of year 2 is a current liability, and there is no non-current portion. And that's it for the presentation of the balances. So, now, before we end this video, guys, let me tell you this. This here is already a complete analysis of this problem, of this non-interest bearing note problem. Okay? And with this, you can already answer all the possible questions. So the complete analysis that I'm talking about is actually this completed timeline and these entries and this current and non-current portion analysis. Okay? And again, with this complete set, you can already answer all the possible questions related to non-interest bearing notes payable. Like, you can be asked what is the initial balance, or the subsequent balances of the notes payable, or the interest expenses. You can already answer those. And by the way, interest expenses could be extracted from these entries, or you can compare the before interest and the after interest balances. It's up to you. Okay? Another is that you can also get the discount already by means of comparing the undiscounted amounts with the carrying amounts that we have here. Like in the beginning of year 1, the undiscounted amount is 1 million. And the initial amount that we recorded is 800,269. So you just have to compare it and then get the difference, and you have the discount balance already. Okay? One more. How about the end of year 1? You just have to compare the carrying amount of 596,301 with the undiscounted amount. So the undiscounted amount is not 1 million already. That's 1 million minus the first payment of 300,000, which is 700,000. So 700,000 minus 596,301, that's already the discount. Okay? Now, how about the discount amortized? Now, you can also answer this. You just have to compare the discount at the beginning of the year versus the discount at the end of year 1. Get the difference, and that's the discount amortized for year 1 already. Okay? You can follow that pattern to get the discount and discount amortized at the end of year 2 and at the end of year 3. In addition, you can also be asked how to make journal entries. We have that here. Okay? And finally, you can be asked about the current and non-current portion of the liability, and we also have that here in this analysis. Okay? One last thing before we end this video. I told you that the very first step in accounting for non-interest bearing notes payable is to get the present value of the payable, right? Now, there is an exception to that, and that is if the maturity term is 1 year or less, don't discount anymore because the discount effect is very immaterial. Okay? So that's it for this video. That's it for the non-interest billing notes payable. And if you learned, please click like, subscribe, and hit the notification bell or follow me and my page to be updated on my next videos. Again, thank you for watching and see you on my next one.